Good start.
And there's Bob.
You're live.
Hi, everyone. Welcome to our online training session. We are sharing our webcam, and please note that your lines will be muted, but you can ask questions by typing them into the chat box on the right side of your screen. They'll be answered at the end. We're going to keep the presentation moving because we have a lot to cover, but we will take questions to the extent possible at the conclusion of today's online training session. After the webinar ends and Webinar Jam, that's our program that we're using today, is closed, we ask that you complete a short survey, which is very helpful to us. And if you have any technical problems during this presentation, you can email our marketing director, bwertman188@gmail.com, and she'll hope to rectify those problems as we progress. We're very excited today to have two participants that will be part of a program that we do each year. And this year we're calling it Breakdowns and Breakthroughs in Long-Term Care. And certainly we've had a number of both. We have situations with Medicaid that are becoming more and more difficult. We have products, insurance products that are very innovative, that are becoming more available. So we have solutions that are coming online, but problems that persist in the long-term care systems. And you're all welcome to join us at our annual forum, which is this year, May 31st, 2018, 8:30 to 3:30 here in Albany, New York, or Latham actually, at the Century House. It is free to attend, seating is limited, and we're going to give you information at the conclusion of today's online session as to how you can register for that program. And I'm going to give an introduction to our speakers in just a moment for today's portion. And they're, again, both going to be part of the program on May 31st. And this is a precursor to that forum, precursor session 2. We did a precursor last month on Medicaid and the government financing solutions for long-term care. And today we're very happy to be doing the update with regard to insurance and the insurance and private financing side of long-term care, expanding your opportunities for planning with long-term care riders and hybrid solutions. We have another precursor session, our last of the 3 in the trilogy, which is going to be May 9th, and that's a very exciting one because in addition to the financing side of long-term care, the technology available to provide care is expanding at a very rapid rate. And we have 3 very, very successful CEOs, founders of startup companies that are providing services to individuals, both in nursing homes and at home, that integrate technology. So you're welcome to join us at that as well, which will be noon on Wednesday, May 9th. And again, you can sign up at the end. We'll give you the instructions with regard to registration. With that, this is Advisors Insurance Brokers and Bob Vandy, who I'm going to introduce next. And we have expanding your opportunities with hybrids and long-term care policies. You see Bob and I on screen. Who you don't see is Shawn Britt. We're having a little technical difficulty with Shawn's computer, but her voice will be with us. And she's the Director of Long-Term Care Initiatives and Advanced Consulting Group at Nationwide Financial. And Shawn is a recognized expert nationally on private long-term care financing solutions. She's authored articles, speaks around the country. We're very happy to have you, Shawn, today on today's online training session. And the other gentleman there is Bob Vandy, President of Advisors Insurance Brokers, the company also known as National Long-Term Care Brokers. And Bob and I have a history together. I won't tell you what all of it is, but the professional side of it is that we share a radio show. We'll be on the radio tomorrow. We've been doing that for 8 years and have shared educational opportunities for advisors and attorneys over the years, with his new role being President of Advisors Insurance Brokers. And with that, I'm going to turn it over right now to Bob Vandy and Shawn Britt.
Lou, thanks very much. Really great to be here today. I know I'm thrilled to be part of another Elder Law Forum, and I'm equally thrilled, if not more thrilled, to have Shawn and Nationwide's involvement this year. I've had the pleasure of working with Shawn and hearing Shawn speak on any number of occasions. And when it comes to leaders in our industry and people who really understand the financing part of it and the importance that the private insurance solution can play in that, and the innovation that takes place in a lot of the products, as Lou alluded to, boy, there aren't a whole lot of other experts that know more than Shawn. In fact, you could probably count them on one hand if there are any. So I'm thrilled to be able to share the airwaves with her today, and everyone will have a better idea of that and have an opportunity to hear more directly from Shawn when she's with us on May 31st. So I know personally I'm looking forward to that, and I know that everybody that's going to be in attendance is going to get a lot out of Shawn's presentations at the forum on May 31st. So if you haven't already registered, please do that. It's going to be a great day, as it usually is. In terms of our presentation today and the ground that we want to cover, you should see on your screen our agenda, and Lou alluded to it. The industry has changed. The long-term care planning industry has changed, and the long-term care financing part of things has changed a lot. There have been a lot of changes that have gone on with the traditional or standalone long-term care insurance market. We'll talk a little bit about that. More recently, we've seen very innovative products that have come out that have combined benefits from a life insurance and a long-term care planning standpoint, and taken a step further, they're products that avail themselves to the ability to be used with both insurance and legal planning together. And we're going to talk a little bit about that this morning as well, or I guess afternoon for most of us here. We would be remiss if we didn't talk about, at least to a degree, the public funding end of things. So we'll talk just really briefly about what's going on in the public funding sector and how realistic is it for our clients to rely on some of those public systems as a true financing mechanism for their long-term care planning. I will take a few minutes and talk about, and I've capitalized it here for effect, but the truth about standalone long-term care. These new innovative products that have come out are really tremendous. They can become so flexible in terms of their planning mechanisms. But I think it's important that we don't lose sight of the fact that there are instances where a standalone product may make sense. It's just a market that has been very volatile, in particular from a rate stability standpoint of late. Fortunately, here recently, we've seen some studies that have come out and said that there's probably more stability than we've had in the past with the pricing on those policies. So it's certainly an area that shouldn't be overlooked, though not the focus of what we're going to talk about today. And then at the conclusion of our remarks, we'll talk a little bit more about that fusion, if you will, between the insurance funding mechanism and the trust in order to provide that ultimate in flexibility in advanced planning, in particular for clients out there. So in terms of where we hope to go today, that's just a kind of a peek under the tent of not only what we're going to talk about today, but also what Shawn will cover in her time with us at the forum on May 31st. So thought it would make sense to start at the beginning, as they say. So Shawn, if you don't mind, I'm going to go ahead and turn it over to you and let you kind of clue our listeners and viewers in on what's going on with some of these products that do indeed fuse legal and insurance planning. Why don't you go ahead and take it?
Okay, thanks, Bob. Yes, the really exciting thing is long-term care insurance or coverage. I like to call it coverage because it opens up a broader spectrum of things that you can discuss with your clients. It's no longer just about standalone policies. There's other options. And what we want to make sure is that we're choosing an option that best meets the needs of the client. You may have someone right now, maybe they're a little younger. We all know selling long-term care insurance to someone under 45 becomes relatively difficult. But if they need insurance to protect their family, there's riders that you can add to life insurance, and it makes sense. It's what I call step one in long-term care planning. It's not hard to add a rider to a life insurance policy. The cost to add the rider is so small, it's almost silly not to do it. It's step one in the planning. And what you've created now, instead of maybe selling them a term policy for the insurance need, you sell them the permanent product, add the rider. We now have step one in the long-term care planning. When the policy is no longer needed for family protection, it transitions to their long-term care coverage. Now, it may not be enough, because that's why I refer to it as step one. But what we've done is, one, we've got something on the books for them should their health change before they're ready to actually talk about long-term care specific solutions. So at least something is in place. So it's a good start. And then down the road, if you're still, insurable and have the funds to add coverage, then you can look at one of the other options out there. One of those options may be asset-based. Now, when they say asset-based, what they're really, that was a term that was used primarily because the original asset-based products were single premium. And so it was considered an asset in your portfolio. Today, the asset-based also encompasses multiple pays. And some people like to refer to them as linked benefit products because that's really the description technically of how the product works. So it would be it's the buckets of money approach that I'm sure many of you have seen. It's two buckets. The first bucket is life insurance with a long-term care rider. The life insurance is small. It's not meant for family protection. People who need family protection or other life insurance needs should use the life insurance policy with the long-term care rider, or what I like to call the single bucket approach. So with our asset-based, our two-bucket approach, that first bucket with the life insurance is really intended to have money that can be given back to the estate if they never need the long-term care. So there's no use it or lose it, but you get a policy that looks like a standalone. It looks and acts like a standalone, gives you similar benefits, more choices, etc. And they have return of premium features. Those vary by company, and these are return of premium to the policy owner who may change his mind and want an exit strategy. Now, the thing that defines all of these policies is whether they're reimbursement or indemnity or cash indemnity. There's actually a difference between indemnity and cash indemnity. A lot of people don't understand that. So I'm going to actually quickly go through all three. So reimbursement policy is only going to, it's exactly like it sounds, it's going to reimburse actual expenses that are covered under the policy. So different policies may have different things that they do or do not cover, especially it's those extras, like, some policies may allow for an informal caregiver, but not an immediate family member to provide care, where other policies might not allow either. Most reimbursement plans do not allow immediate family members to provide any of the care and be reimbursed for it. They also may limit things like how many home modifications you can do per claim year, or limit the types that you can do. So there could be some limitations. You don't have the same freedom. You can't use the money to pay for prescriptions or doctor visits, that type of thing. It's going to be literally what's covered under the contract. An indemnity policy is different. You're literally, once you qualify, you're getting a check. Now there's two kinds of indemnity: professional indemnity and cash indemnity. Professional indemnity, that also has a variance of how strict it is. But generally, just to be brief, it requires licensed care be provided to some degree. It doesn't have to be all done by licensed care, but to some degree. What that degree is, again, will vary by the company. Whereas a cash indemnity policy is not only going to pay all the money each month, but there's no restrictions from the insurance company on how you spend the money. So as Bob says, cash is king. You literally have the freedom to choose what you want to do. And just a quick story, I got a call one day from an advisor. He had a client who was testing the flexibility of the policy she was considering. And the question was, my client says that if she ever needs care, she wants someone to get her on an airplane, take her to Tibet, and have the Dalai Lama pray over her. Will your policy pay for that? And so far, they'd gotten no's from all the phone calls they had made. And our answer was yes. Because we happen to offer a cash indemnity solution. That was the key, no restrictions. And does she want to go to Tibet? I doubt it. I think she was imagining the wildest story she could come up with to test the flexibility of the policy. And so that's where cash indemnity becomes very different from even regular and professional indemnity, or even more so reimbursement. You have that total flexibility to do how you want. Now, one of the things you want to be careful with is there's things called chronic illness riders. And it's a confusing term because to be able to go on claim with a standalone policy, with an asset-based long-term care, with long-term care riders on life insurance, or long-term care riders on annuities, you have to be chronically ill per the definition of the tax code, which means 2 activities of daily living impaired or cognitive impairment. Chronic illness riders is simply the name of a product, and it confuses folks. But a chronic illness rider is not as comprehensive. Some will pay the full death benefit or accelerate the full death benefit, and others will discount. They will tell you there's no charge. Please do not think that means free. It is not free. What they do is discount the death benefit. So you'll accelerate $100,000, but your client may get $65,000 in hand. And that other $35,000 is gone. It's never paid to anybody. That is the cost of not being underwritten. So there are uses for these, and one of them would be if you have a client who is not long-term care insurable, but still life insurable. It's better than nothing, but you want to be very, very careful when you're reading a chronic illness rider contract to understand what you will get and what you will not get. And another thing you will not get is the consumer protection.
Shawn, that's helpful, and I'm glad you brought up the chronic illness versus the long-term care riders, because that's an important distinction. And it's, not to toot the horn for Nationwide, but that's one of the things that we like about the Nationwide product in particular, is that if you combine the fact that it is a long-term care rider by definition, and there are different areas of the Internal Revenue Code that govern these, it's a long-term care rider. So it's important, I think, to point out that a lot of the chronic illness riders, it's starting to change a little bit, but a lot of the chronic illness riders require what's known as an expectation of permanence. Certainly that's historically been the case in New York State. Only now are we starting to see some cracks in that particular egg. But a lot of the chronic illness riders that have historically been out there, not only do you need to trigger benefits by having either 2 of the 6 activities that you can't perform or the cognitive impairment, it has to be considered permanent. So that's important, and there are other differences that go beyond the amount of time we have to spend today on it, but I'm glad you brought that up. And it is interesting, too, that discounted death benefit product, even though it does not charge a separate premium, I agree with you 100%. That doesn't mean that it's quote-unquote free, so I'm glad you brought that up.
And Bob, the interesting thing, if you just take someone, if you do an example and do the math on someone who's just on claim for a little more than 2 years, you'll be shocked at how much death benefit was forfeited. It was way cheaper to pay the rider charge.
Right.
It made way more sense to pay the rider charge than to think you got something for free, because you really didn't.
Great point, Shawn. And as we extend that, now we've given a little bit of a foundation in terms of the newer products that are out there, and at least some of the subtle differences in terms of how they work. Now we start to look a little more deeply at how I might be able to bring the 2 together, the 2 being the insurance solution and the legal solution. I know you've got some observations in terms of the use of trusts, the use of these products in a business planning environment. Why don't you walk us through some of your thoughts there?
Sure. One of the exciting things when you have an indemnity, and I don't mean to keep pushing Nationwide, so please don't take it that way, but we do have an indemnity policy and actually cash benefits, and that has allowed me to dive into different ways these policies can be used. The reimbursement policies, some of the ideas I'm going to throw out to you today could be used by a reimbursement. Some could be, but it's not practical, and then others you can't. So what the nice thing about indemnity is the world is your oyster. You can do any of these situations. One of the ones that you have to have an indemnity product for, it could be professional indemnity or cash indemnity, but it has to be indemnity in order to use it in an ILET for estate tax purposes. And I am defining that specifically. You can have an ILET, but it may not be meant for estate tax purposes. My parents had them. We were not rich people, but we had some dysfunctional family issues to deal with. So my parents' estate was handled by an ILET to lock down protection for the people who needed the protection. So assuming if your client has estate tax liquidity problems and they're buying life insurance for that purpose, we can use an ILET and add the long-term care rider to it. Now, if you're thinking, why would people who have estate tax problems now are worth, if they're a couple, they're worth over $22 million. Why are we bothering? They can self-insure. The reason is these people have a risk the rest of us don't have. It's the risk of self-insuring, or as I call the cost of getting lucky. They set aside some money in the estate to pay for long-term care, and they die in their sleep. What happened to the money they set aside? It's getting estate taxed. And they could lose up to $400,000 of that $1 million they set aside. So instead of subjecting them to that risk, we go ahead and put a rider on the life insurance policy they need to do for the estate tax planning. And I'm not going to go through how you get it out, but it's important to know it has to be an indemnity plan to get it out safely. So that's one thing that you can do. Q-tip planning is, second marriages. You can have a trust set up, or there's other, types of trusts that you can do. But trusts with HEMS provisions are very easy. You may have a trust set up for spendthrift purposes, a Q-tip set up for a second marriage. You want to provide long-term care benefits. The HEMS provision can distribute it. So that's a very easy way to do it. But a lot of people don't realize that you can deal with long-term care in some of these trusts you're setting up for other purposes. So you really can do some double duty planning here when you think it through. One of the exciting things that you can do with true long-term care products, and in this case, you could use a reimbursement plan, but it's not practical. I don't think the business would want to do that. But it's not that you can't, it's that you really don't want to. In some of the business ideas that I'm going to briefly bring up. Now, the one area where you could use the reimbursement plan is the Section 162 plan, because that's going to be owned by the insured. So the business simply is going to bonus money to the employee, but they're going to directly make the premium payment. It's going to be considered compensation, so the business gets to deduct it, and the policy owner is going to have to claim it as income. However, and pay tax. However, if the business really values them, they will do what's called a double bonus, and which means they're going to bonus enough to pay the premium to the life insurance company and then send the tax that would be due for the bonus to the IRS and pay the tax as well. Now, on a Section 162, the insured will actually own the policy. And if the business is worried that they'll pick up and leave, they can do a restrictive executive bonus arrangement, known as a REBA, and they can put some silk handcuffs on that policy for a period of time at least, to make sure that the policy owner can't just pick up and leave, or if they do, they have to pay the money back. Now that would be owned by the insured, so any benefit plan could work. But there's other things that you can do, and to do these other things, I'm going to mention, you have to be a 7702B long-term care policy. There are a few long-term care policy writers on life insurance out there that are long-term care writers, but they're not under 7702B. It's sort of a rare filing, normally used by whole life companies. What I'm about to talk about cannot be done by those typewriters. It has to be 7702B. And the reason is That tax code also delegates that the benefits are considered accident and health benefits. Only 7702B products have that distinction. And as such, you now have a variety of things that you can do as executive benefits. So a company could, for example, they could purchase an asset-based, a linked benefit policy on their top 5 executives, providing them long-term care. If they were to die while they're still working, then the business would keep the death benefit to get the money back from what they invested into the person. But if they survive, or if they need, let's say they need long-term care while they're still working for the business, maybe they have a car accident or they've been out mountain climbing and fall, a jet skiing accident, then the business can literally pay them long-term care benefits tax-free. The business would get paid to the business because these contracts are owner-driven, but the business will get to collect it tax-free as an accident and health benefit and then pass it through to the employee tax-free as an accident and health benefit. They will not get a tax deduction, however. That's important to note. So if they want tax deductions, they'll want to do the Section 162 plan. However, it's becoming long-term care is becoming a more popular executive bonus, and this is a nice way to do it. There's also a kind of a neat way for small pass-through businesses. You have an owner who at the end of the year calls you and says, hey, I've got some money I want to get off the books. What do I do? Can you get me some tax deferral or get me some tax deductions? Well, the answer is no. They're still a business, so you can't put it in an annuity for tax deferral, and because for a business it would not be tax deferred. And there's no tax preference, no tax deductions out there. So one suggestion would be to tell the business owner, look, you have to think about what would happen if you were to have an incident where you couldn't take care of the business, or even down the road when you get older, a long-term care event that could happen. And so let's look at taking this money and depositing it into a linked benefit policy. Now what we're going to have is, if you want to expand the business, you've talked about expansion, you don't know if you're going to do it or not. If you want to expand in 5 years, you can get the money back. If you find other funds to expand the business with or don't expand, you have long-term care protection. This is a cash product, and this is where cash really helps. Again, you want it to be cash because you want the flexibility for the business owner to not only use it to pay for his care, but maybe use it for some of the extra expenses he may have trying to keep the business running while he's not doing well. And then, of course, once you sell the business or you hand it over to your kids, the policy can be transferred to your personal ownership. And because you were a pass-through, remember this does not work for C corporations. It has to be a pass-through. Because you were a pass-through, you're going to be able to transfer the policy to your personal ownership tax-free, and there will be no transfer for value. Now, in truth, he's a pass-through. He bought the policy all along, but there's a psychological element to being able to tell someone, let the business buy it. So this is another idea you can do when you have a cash policy. Now, one of the things people bring up to me every so often, especially when there's a case that gets settled like there was back in 2012 in Pennsylvania, filial responsibility. And for those of you who don't know what that is, it's laws that are on the books of 29 states and Puerto Rico. And the original filial responsibility concept was brought over literally by the Pilgrims. It was a law established in Elizabethan England. And what it really means is that you are financially responsible for your relatives. Well, in the United States, that only extends to adult children being responsible for their parents. It does not extend to grandparents or other existential relatives like the original Elizabethan law did. People, every time, it comes up in a magazine article, people worry, is this something I have to worry about? Well, one, I personally don't believe that using the filial responsibility argument is a good way to scare a client into buying long-term care. I don't even consider it to be the most honest approach as well, because for the most part, unless you live in one of the states that are actively using these laws, and New York, by the way, doesn't even have it on the books. It is not one of the 29 states. And most of the states that do have it on the books only use them when there is clearly an unclean situation going on. And unclean means basically the kids were manipulating the parents' finances to try to get them on Medicaid and not doing it the right way. That's generally when they're used. Now, if you live in Pennsylvania, if there's anybody or doing business in Pennsylvania, you folks do have a little more to worry about. Those laws are very active there, and there have been cases, most notably the 2012 case, the PTOS case, where a son was made to pay $93,000. He had done nothing wrong. He just happened to be, his mother was the one who skipped the country, but he was the one with money. They're the ones he sued, and he had to pay. Most of the time, this is not something you have to worry about, but people ask about it, so I thought I would bring it up. But if you're doing business primarily in New York, this isn't even a concern for you.
Shawn, that's great. Thanks. Appreciate that. We've been spending a fair amount of our time talking about the private insurance environment, and we're going to come back to that here momentarily. But I think it's probably a good time for us to talk briefly, and this is a topic that Lou and the team at the forum are going to get into in much more depth. So we're going to only scratch the surface here, but there are a couple of important points to make. Let's chat for a moment about this whole notion that, well, gee, I don't really need to do any planning as a client because mother government is going to take care of me. So give us a feel as we go through what's going on the public financing side of things in your view relative to some of the programs that are available on the public side.
Well, unfortunately, too many clients don't know the difference between Medicare and Medicaid. So they think Medicaid is their answer. And it is sometimes. It depends on what state your clients are financially. But unfortunately, too many people think that Medicaid just covers them. So we have to educate our clients and point out to them, you've got $2 million in assets, you're not a Medicaid candidate. And the most practical thing to keep your choices are to buy a long-term care coverage of some kind. And I know Bob's going to talk a little more in a moment about managed care in New York. And New York traditionally has been a little more liberal in regards to what Medicaid can do. Most states, if you are on Medicaid, it's going to be for nursing home care.
Sure.
Again, there's little pockets of communities that have a little more liberal choices out there. But for typically outside of New York, nursing home care is going to be the care you will have to take if you're going to rely on Medicaid. Most of our clients do not want to go to a nursing home. In fact, that's the reason they don't buy long-term care insurance. They think it's nursing home insurance. And that's another thing. We want to keep people in their home as long as possible. And the best way to do that is to have long-term care coverage. Now, Medicare, again, people think Medicare, and they will swear their neighbor's mother had their long-term care event covered by Medicare. Well, maybe they did, but here's how it happened. First, the mom went to the hospital. She stayed for 3 consecutive days under treatment, not observation. And she probably got checked in at the beginning of the month, and that I won't go into why I said that, but yes. So 3 consecutive days in the hospital under treatment, not observation. And then she went to a skilled nursing facility. The first 20 days were paid by Medicare. And then mom also probably had one of the better Medigap policies. If you have one of the better Medigap policies, then that is going to pay your Medicare copay for days 21 through 100. And then mom got well on day 90 and went home. And therefore, in mom's and her daughter's view, Medicare paid for it all, and oh, Medicare must pay for long-term care. No, they don't. They pay for short-term recoveries and skilled nursing facilities when there's been a 3-day consecutive day in the hospital under treatment. So that's something that our clients are very confused about. They just think it pays for it. And they bought their Medigap policy and it had a mention of long-term care in there. They think that's covering it, which it's not. Again, it's covering them. If you buy the higher price gap policy, it'll pay for the copay. That's it. I'm going to turn it back over to Bob to talk about managed care in New York.
Yeah, I did want to make mention of that. Thanks, Shawn. And I think one of the main things that we can take from this part of the presentation is the fact, and again, we're only scratching the surface. Lou's going to get into this, and some of the speakers at the forum are going to get into this in a lot more depth and really specifically as to what's going on here in the state of New York. In a broad-based sense, I think it's fair to say that our elected officials, our legislators, our lawmakers, they would certainly like to go a lot further relative to how much they free up public dollars to help offset and mitigate the need for long-term care and pay for that care. But the reality is you get to a point where you have to sharpen your pencil and you have to find the money to do it. And it's becoming increasingly difficult to find those dollars. Here in New York State, for example, we've recently gone and Lou mentioned the radio show. I remember going through when, right, Lou, we had Governor Cuomo created the Medicaid redesign team.
Yes, I remember it well.
Yeah, and one of the basic tenets or one of the basic conclusions that came out of that was the notion of having a managed care model for home care in the state of New York. What are your observations, if you don't mind me tipping it to you here for a minute? What are your observations on where we stand with managed care relative to the availability, the process, and so forth?
We've covered the move to mandatory managed care in our Elder Law Forum for the last 5 years. We've had a number of speakers, Senator Kemp Hannon, who's chaired the Senate Health Committee, and others from the government, from the Department of Health, to talk about it. But what has happened is that the managed long-term care system, if you will, is a capitated payment system, which was designed to stop the growth in New York's Medicaid budget. As Shawn astutely pointed out, New York has been much more generous with home care Medicaid than almost any other state. And we did a study on this. I was on the governor's task force on long-term care reform, 1996. And we looked at it, and back then, New York was spending as much per patient on home care as the next 11 states combined. Since then, other states have actually brought more waivered services programs in the home into their Medicaid realm, but it's still very much more limited than New York. So New York put in mandatory managed long-term care to stem the tide and to cap the costs by giving an insurance intermediary the money to then manage the care and purportedly to improve services and efficiency in the delivery of care in the home. Well, it's become a managed billing system, and we kind of knew that at the outset, and it doesn't really manage the care for individuals in the home. It has been more of a capitation on the number of hours that you get. So that system has been subject to the state's fair hearing appeals process, but May 1, that whole thing is changing. And what has happened is that the managed care company will deny hours or limit hours of home care, and you could go to a state judge and get an appeal approved in a very short period of time. May 1, we're flipping to having to exhaust each insurance company's internal appeals process before we get to a fair hearing. And it's become much more difficult to get care. The lag time between application for Medicaid and the time you actually get service in the home in our area is about 4 months. In some downstate areas is longer, 8 to 9 months before you get service. And of course, you need service when you need it. And so the system is kind of bulging at the seams in terms of the numbers of people who need home care, who want to get Medicaid home care and the amount of money that's coming through the budget through the MLTC companies. So we have Mark Kissinger, who's going to be with us on May 31st, who is the special advisor to the Commissioner of the Department of Health. And Mark has a 30-year history in New York with long-term care. We have Valerie Bogart coming up from the New York Legal Assistance Group, who's the leading attorney in the managed care realm in terms of doing appeals and talking about the issues. And so we're going to give it a full treatment. But what I've always advised our clients, Bob, and you know this from our 20 years of history, is Medicaid isn't going to be around forever, and the amount of assistance that you can count on through Medicaid is just going to dwindle. And Shawn pointed out the Medicare versus Medicaid conundrum. Most people don't know the difference between the programs and think that Medicare is going to cover long-term care. We have Beth Finkel, who's the statewide director of AARP, who's going to be on the panel May 31st. AARP does surveys every year or two. And one of the questions they ask is, how will you cover long-term care if you need it as you age? The last poll I saw was 63% of seniors said Medicare is going to cover long-term care. It will not. The other survey they just did that Beth's going to talk about said 9 out of 10 people want to be taken care of in their own homes. That's a difficult chore when you've got this system that is now throttling down on the amount of care that you can receive through Medicaid. So we've advised our clients over the years to look at private financing solutions and the insurance products, and in particular, the value of indemnity products and cash when it comes time to go out to that marketplace and actually purchase services.
Lou, thanks. And I don't think that's going to come as any surprise to anyone to hear that the availability potentially as we go forward could dwindle. It could become more restrictive with a lot of the public programs. And what we've also observed is that in an effort to perhaps supplement what the government might do on a direct dollar for dollar basis, they've tried maybe a patchwork of some other things, including tax incentives and asset protection. We're not going to really get in too much to the New York State Partnership for Long-Term Care today, but partnership asset protection is something that started here in New York and 3 other states, Connecticut, Indiana, and California, and more recently in the last 10 or 12 years has spread more, such that a lot of the states have partnership asset protection for traditional or standalone long-term care insurance. One of the things that we've looked at and that we've seen is the desire for our lawmakers to make some tax incentives available. And I'm going to turn it back over to Shawn and have her provide some commentary on the PPA, which is our first big acronym for the day, I think, which Shawn will tell us what that means, but what that means from a tax standpoint, and then talk about perhaps what we'd like to see on our wish list with regard to some of these newer products and the ability to extend some of that asset protection that we currently do extend to standalone long-term care. So your thoughts on that, Shawn?
All right. Well, our first acronym of the day, PPA, stands for the Pension Protection Act. And what that act did was it changed the 1035 rules a bit. And those rules now state that if you have cash in a life insurance policy, an endowment contract, or an annuity, that cash can be 1035 exchanged into a standalone long-term care policy. So it's clear to understand the rule pertains to traditional long-term care. Sounds great. It was a great idea. Unfortunately, when the PPA passed, this law was also about the time that single premium products on standalone long-term care, the ability to pay with a single premium, started dissipating because interest rates had gotten so low that the companies did not want to take a single premium and have to invest it at very low interest rates. They wanted to have continuous premium come in so they would be able to keep rotating the investment and hopefully do better on it. So just about the time we had this great opportunity thrown at us, we lost the ability to find single premium products. Now, there's still a couple of options to use this law. One is not practical, especially if you live in New York, and one is to do partial 1035 exchanges from an annuity every year into a standalone policy. The problem in New York, you don't just have the annual 1035 paperwork. That includes Reg 60 paperwork, which of course the other states don't have, but it's still a cumbersome process. And then also one thing that I would recommend, if you were to go through this process and were willing to do it, I would highly recommend that you purchase a long-term care policy with a return of premium. Because remember, if they never need the policy, we just took a cash-rich annuity and literally the money is gone if they never need care. So you want to make sure there's a return of premium feature to preserve the cash that came from the annuity if they were to never need the policy. You don't have to do that, but it's my personal opinion that from a fiduciary standpoint, especially if you have to answer to their children, where'd the money go, it's a good idea to put a return of premium on that standalone policy. The other option you have is, let's say you have an annuity, has a lot of cash value, has a lot of gain in it. What can you do? Well, there are now annuities with true long-term care riders that you could 1035 from the annuity without a rider to an annuity with the rider. Remember that the 1035 exchange rules are all based on the base product. One of the biggest questions I still get is, can I take my annuity and 1035 it to a linked benefit product on life insurance? The answer is no. Linked benefit products on life insurance are still life insurance contracts for the purpose of 1035 rules. What you can do, though, is take a life insurance contract without a rider and 1035 it into either another life insurance contract with an LTC rider or a linked benefit product for long-term care that has a life insurance base. So just remember, the base product always determines if you can do the 1035. And what we have now is a new rung on that ladder, standalone long-term care. But otherwise, and you cannot, by the way, 1035 one standalone to another. Not that there was any cash value, but I've actually gotten that question, and it is clearly addressed in the Act that you can't do that. Now, as for partnership, one of the things on the wish list of many of us is that the government would allow the linked benefit products, or some, as I said, some people call them asset-based, to qualify for the partnership program. We're hoping that this can be done. So far, nothing has happened, but they're already designed to meet the rules of the partnership. You have to have 5% compound inflation as an offering, which they do, you know, there's a lot of things that these policies have to have. Linked benefit products has the ability to do that. So we're hoping that the government, the main problem with the linked benefit product, it's based on life insurance and it's cash rich. So right now it doesn't work because you would have to spend it down. If they could waive the spend down and maybe the products make some minor adjustments, this perhaps could be done, but we still have to get government buy-in. As far as extending partnership qualifications to life insurance with long-term care riders, that's going to be a tougher one to do because the number one reason, there's no inflation. And you can't really put inflation on them practically because you're accelerating a death benefit. There's no extra buckets, and just the design of the product does not set well with trying to get a partnership approval. But we're hoping to see linked benefit products maybe be accepted into the partnerships in the future.
Shawn, thanks for that. Appreciate it. Yeah, it would be certainly a nice feather in the cap for our industry to be able to offer that. But you're right, it's a complex issue and one that I don't know that we're going to resolve in the next month or two or 6 months or 12 months or 18 months. So stay tuned for more on that. I'll take a minute and just go through, I think it makes sense, as I mentioned earlier on, it makes sense to talk about what's going on with standalone or traditional long-term care insurance. And again, when it comes to the flexibility and the ability to combine planning between the insurance side and the legal side, there's not as much play in that, so to speak, with the standalone long-term care insurance market, but I think it makes sense to at least reflect on where we are with standalone long-term care. And my first bullet there that you can see, past performance is not a true indicator of future results, is reflective of the fact that my sense is that we're at a time where people are frankly fed up with the announcements on the rate increases on long-term care insurance, and frankly, understandably so. When it comes to how we got here, I think as much as that is an unpleasant conversation to have with clients, I've certainly had those. It's an unpleasant conversation to have with our fellow advisors. I've had those as well. I think it's important to couch that with where we actually are today and how we got here. The reason that we've seen, and I'm going to give you the really short version of why we got or how we got here, but how we got here with the volatility on premiums with standalone or traditional long-term care insurance has to do with two main properties. And it really goes to the persistency rates on the policies and the interest rate environment. Persistency rates basically means, hey, what percentage of people are going to keep these policies over a long period of time? And the standalone long-term care market, even though it's been around arguably for 30 or 40 years, that is fairly still in its infancy when you compare it to how long life insurance or even disability income or income replacement insurance has been around. So the long-term care insurance industry maybe didn't have as much history to go by in terms of determining what should we anticipate in terms of a lapse rate, how many people will drop these policies over time. So they started in the arguably 93, 94% range of people that they expected to hold on to the policies long term. What we've actually seen in our industry is about 98 to 99% of people have held on to their policies. Now, that in and of itself might not mean anything to you, but if we extend that, what does that mean relative to claims experience? And as you might gather, the more people who keep their policies, the more people do what? Use their policies. So that has thrown the claims assumptions that the actuaries had used for the claims part of the pricing on long-term care insurance way out of whack. The other thing that has happened is the lower interest rate environment. We're still there. We seem to be creeping up a little bit here or there as the Fed takes certain actions and the market responds. But if we flash back to when long-term care insurance had its really strongest years back in the 90s and even into 2000, the average interest rate environment, say for a 10-year treasury, was upwards of 5.5 or 6%. Well, those of you who follow that particular number, which is largely indicative of what's going on with interest rates, it's more like in the 2.5 to 2.8% range is what we've seen here in recent years. Well, insurance companies have to be very conservative in terms of how they invest their premiums. The result of all that has been all those expectations of earning 5.5 or 6% on those conservative assets that they invest. When those bonds have become matured or they've matured and they've come due and they needed to be replaced, the insurance companies have not been able to replace them at 5 or 5.5 or 6%. They've had to replace them at 1.5 or 2 or 2.5%. That has a significant impact on the reserves and by extension, the rates for long-term care insurance. So there's been this perfect storm of the interest rate environment and persistency rate environment together. That's the bad news. It's also the good news. And what I mean by that is there was a recent study that was done by the Society of Actuaries in November of 2016 that took a look at where pricing is for traditional or standalone long-term care insurance. And it studied it to say, well, what do we think is going to happen on a go-forward basis? Rates are a lot higher now for long-term care insurance in a standalone sense than they have ever been because of the impact of those indicators that we talked about. The good news part of that is that although rates are certainly much higher than they've been in the past, we could make a reasonable argument that they're going to be on a go-forward basis. And it's exactly what the Society of Actuaries study concluded, that rates are going to be a bit more stable here go forward. In fact, they estimated that they anticipate that there's about a 10% chance of a policy, long-term care standalone policy being issued today, that policy will incur a rate increase on a go-forward basis. And if it does, they estimated it would be on average about 10%. Certainly a far cry from what we've seen. So that's the good news. The thing we have to recognize is that there's what I like to call a hangover effect, where people might look at that intellectually and say, okay, I understand that, but I'm still nervous about it. One of the other advantages that we've got with some of these newer products that Shawn's been talking about is that we don't have to worry about that rate volatility with many of those products. the rates on those products are guaranteed. So for clients who may have a desire to plan for long-term care in the ways that we're talking about, and they may be reluctant to look at standalone or traditional long-term care because of, among other things, the rate stability issue, these newer products avoid that issue and can arguably help the client feel a lot better about that. From a product design standpoint, we've seen some changes here as well. Historically, and Lou remembers this well as well in our 20 plus years that we've been working together, it was not unusual historically to find policy designs where I designed the policy to pay a daily benefit that was mapped to what? The facility cost for that particular area. Well, that facility cost here in the Albany, New York area today might be $360, $380, even $400 a day today because we live in a high cost area. That takes that policy design out of the affordability spectrum for a lot of clients. So what we're seeing more and more is clients understanding and advisors understanding, frankly, that maybe it doesn't need to be an all or nothing proposition. Having some level of coverage that pays, as Shawn talked about and Lou alluded to, we know that clients would prefer to stay home if they possibly can. So if I have a policy that can provide liquidity to pay for 8 hours, 10 hours, 12 hours or more of home care, maybe I don't need to have a $360, $380 or $400 per day benefit. Maybe I can have a $200 or $250 a day benefit, and that can go a long way to help pay for some home care. So Lou, you've probably seen changes in those designs and those plans as well, correct?
Absolutely, Bob. And what we have been looking at more, because the partnership, when it was created, was a wonderful concept, but the policies are so rich that they become unaffordable and companies can't even afford to sell them. So what we've been looking at is taking partial coverages and from any product, literally, and using the legal aspect of planning to bring the Medicaid component in, because the partnership is private insurance and Medicaid. That's what you're selling, folks. That's what you need to know. We can create Medicaid eligibility with trust planning. We use something called a Medicaid Asset Protection Trust, and we can pair that with these partial policies so that people do have coverage. They have cash, hopefully, coverage coming in, indemnity coverage coming in, or a reimbursement contract. But if it gets to the point where that is exhausted and their own resources can't foot the bill, then they have Medicaid that they can use, just like they could had they had a partnership policy under the original design. So much, much more combined planning, Bob, than ever before, using the legal avenues of Medicaid Asset Protection Trusts and the insurance products that are available to provide that community-based care. And you forgot one element in New York that is an uncovered risk, and that is on Medicaid, assisted living. And many people prefer the assisted living option, which could be anywhere from $3,000 up to $9,000 or $10,000 per month. You want to be able to insure that risk because Medicaid won't cover it. If you do need the nursing home, you've got the catastrophic coverage through Medicaid using a trust.
Good point. Thanks, Lou, for bringing that up. So we're just seeing more modest designs nowadays, and it's becoming not so much an all or nothing proposition. It's becoming more of a co-insurance. I understand I need to have some skin in the game, and my insurance is there to put skin in the game as well. Coincident to that, and I could have put this under the lawmakers part of things as well, here in the state of New York in particular, and Lou and I and some of you may know Gail Holubinka, who was one of the original architects of the New York State Partnership. We don't really have time to get in depth with the New York State Compact, Lou, but that type of a program lends itself to some of those more conservative based designs when it comes to long-term care insurance, which would essentially merge the two in a quasi-partnership fashion, kind of merge the two, the public and the private funding together. So as we look forward, I think we're going to need to see some of those more private and public consortiums, if you will, to try to determine a better way out of this financing debacle that we have arguably with long-term care.
And we have you all on a panel, Shawn and myself and a number of others, to talk about those financing options on May 31st.
Good stuff coming in much more detail. We're a little pressed for time on that today. I want to take just a quick minute as we start to get toward the end here, Shawn. If you can take a minute to talk a little bit about your viewpoints of where you see the life policies and the riders working in concert with a trust, some of your observations, you've written a number of terrific articles on this topic. So take a moment and give us your perspectives on that. And then what I'd like to do is shift gears. And Lou, maybe you can tell us a little bit more about the parental protection trust that Elder Counsel has as we start to wrap up.
Okay. Well, one of the reasons, especially for people with estate tax liabilities, that I like using LTC riders and or linked benefit products owned by the ILET is that it accomplishes two things. The first, it does no longer subject this client to the cost of getting lucky, as I mentioned earlier. In other words, because they're not self-insuring in the estate, there's no risk that they'll die in their sleep or only use long-term care for a few months and subject all that money they left there for liquidity purposes to estate taxes. So we're handling the long-term care funding through that ILET. The second advantage is that the way you get the money out, which I don't have time to go into today, but it's set up in such a way that it purposely creates a nice debt that the estate owes to the trust. And when you pay that back and the interest that you've created, you're actually moving more money out of the estate over to the trust. And so now you have the potential to grow the amount of dollars in the trust for the beneficiaries by the sheer fact that you needed long-term care. This is a unique situation that only applies to these particular type of ILETs. And thirdly, when you're using an asset-based product along with this this collateralized arm's length loan concept that we would use to get the money out, with the linked benefit products, between the payout of the death benefit and the estate taxes that are saved, the net cost of the policy, if all things went perfectly, could be next to nothing. Literally, I show an example in one of my papers where the net cost of over $1 million of coverage is $3,700. And it's because the money that was paid for that leverage is almost totally recouped by the guaranteed death benefit and the estate tax savings. And then the question will come to me, well, that's all well and good, but if I self-insure and I never needed it, it didn't cost me anything. Well, no, it did. It cost you the $400,000 in taxes on the back end, we're assuming $1 million here. Whereas by doing in the trust, yes, maybe you paid some money for the cost of the rider or the linked benefit product, but when you consider the guaranteed death benefit on the back end, plus compare the cost of the solution you purchased versus the cost of the estate taxes, you're so much better off having purchased the protection. So it's the worst case scenario is still a win with this concept. And the best case scenario is an unbelievable win. So it's a really nice combination to look at. And of course, there's varying degrees of how it's going to work depending on the age of your client and their health and what kind of leverage we're able to get. But the point is, with this concept, it always ends well. It's just a matter of whether the ending is good, better, or best.
Shawn, thanks a lot. Lou, at this point, I'm going to turn it over to you with this next bullet and let you kind of close us out. Really, I want to shift gears and have you talk about a proprietary trust that Elder Counsel has created, the Parental Protection Trust. And then I'll let you maybe give it. I think you've got an example you might be able to share with the group. I know we're at the top of the hour, so I'm going to turn it back over to you.
So I'm going to do about 2 minutes and then we'll close. I know people are having to get to lunch and hopefully enjoy that lunch. But with regard to Shawn's plan design, it's really geared for estate tax purposes, and it works well for that because it does create a loan regime where you're borrowing the money out and then paying the trust back ultimately. The issue with that is that very few people today are in an estate tax situation. New York, we have a $5.25 million exemption going to 5.6 at the end of the year, federally 11.2. But still, trust planning is very important with or without estate tax. And so we've conceived a new type of trust. Briefly, we have a 65-year-old couple. They're concerned about long-term care. They have very good cash flow. and they want to make some gifts, but they're considering leveraging the gifts and leaving legacy to their 2 children and 4 grandchildren. So instead of having the parents, in this case, Mr. and Mrs. Smith, set up the trust and fund it and buy the policy, we're going to have the 2 children create the trust and fund it for the benefit of their parents. So in effect, the children are buying the life insurance policy on their parents' lives, and there are many good reasons for that. The ROI on that life insurance is going to be a decent ROI regardless of what happens, but with the rider, they're going to have the ability to put coverage in place for their parents that will cover that long-term care risk. And if you've been a caregiver child, as I have, you know that's a burden. And you know that if you had some cash at your disposal, that burden would be a much, much easier one to be able to navigate. And so we have created what we refer to as the Parental Protection Trust, with the children financing the premiums and then having that policy held by the trust, which is in effect a third-party special needs trust for the parents' benefit. And what that means is the trustees, the children, can use the linked benefit, the lifetime benefit, to pay for care or not. And so what we very often do is we pair the Parental Protection Trust with Medicaid Asset Protection Planning to go back to that partnership concept. So now you have a linked benefit product, in this case $500,000 on each spouse, that would pay about $10,800 in monthly cash tax-free benefit. And that would go into a trust, which could then either be used to pay for care or accumulated within the Special Needs Trust. You can tag on the Medicaid Asset Protection Trust, and it will give you the same partnership concept, but with what I feel is a very superior product, which is the life insurance with the long-term care rider. So there's no gift tax, there's no estate tax. You have $1 million death benefit combined for Mr. and Mrs. Smith. When one spouse dies, you've got a $500,000 benefit in trust for the other spouse. When both spouses die, the $1 million comes back to the 2 children, and you've got that lifetime benefit that can play in as well. So creative trust planning, there are a lot of ways to skin a cat. You can use a traditional ILIT and a loan, or you can use a parental protection trust and have the children buy the policy. And the question then comes up, Bob, as it often does, well, can the kids afford this? Well, at some point, they're going to be inheriting a lot of money, and that can be accelerated. So what Mr. and Mrs. Smith can do is create a gifting program that they could give annual exclusion gifts of up to $15,000 per child, and that would allow the children in future years to come up with the premiums necessary to continue the policy. We do always like to have the kids come out of pocket, not borrow the money, but come out of pocket, or at least not borrow it from parents, with the initial premium. Subsequent premiums, you can have that annual gifting program that could replenish the funds that the children are paying in. So just another way, Bob, that we do this. And that's the conclusion today. Thank you for hanging with us a little bit over time. And Bob, if you want to give your contact information for yourself and Shawn.
Absolutely. As you can see on the screen, there is the number for our office here in Clifton Park, New York. Certainly feel free to give us a call for any clarification on anything we covered today. And I want to give a big thank you not only to Pierre O'Connor and Associates for giving us the opportunity to participate in the webinar today, but also the upcoming forum. We're really looking forward to it. And then also a big thank you to you, Shawn, and the folks at Nationwide who are helping co-sponsor that event for us. It's going to be a terrific event as usual. And I'm very excited to have you here to be presenting live in person. I'll let you make any closing comments you'd like to make and then give your contact information as well if you'd like.
Okay. I just want to thank you all for joining us today. I look forward to seeing you up in New York at the forum in May. And if you have any questions about anything I spoke about today, you can reach me at 614-249-6741, or you can call our 800 number for one of my other partners up here, which would be 800-321-6064. And our extension is 677-6500. I know it's a 7-digit extension. You can also just go to the operator and ask for advanced sales, and they'll send you up here. and you can ask for one of my counterparts if I'm traveling, which I do a lot of. But I thank you all for joining us. I look forward to seeing you in May, and everyone have a wonderful weekend.
Thanks very much, Shawn. Yep, Shawn is in Columbus, Ohio, so she's at the home office for Nationwide. Lou, I'll turn it back over to you. Thanks a lot.
Thanks, Bob. So again, May 31st is our annual Elder Law Forum, and breakdowns and breakthroughs in long-term care. We have a spectacular panel. We have legislators coming. They're going to be interviewed by Liz Benjamin, who you may recognize from our local television station. And we have representatives from virtually every aspect of long-term care coming to give their viewpoints and hopefully find some new solutions, as we tend to do each and every year. You can register for the forum or for the May 9th teleconference at noon with our CEO founders of the 3 tech companies by clicking on the button on the right side of your screen. And you can go right to pirolaw.com events otherwise, and you can always get an update on what's coming and register for the forum. We hope to see you there on May 31st. So with that, Bob, Shawn, thank you so much for sharing your time and being generous with it, and for the presentation today. Thank you all for joining us. We hope you can join us at the next teleconference and on May 31st. But I will tell you, invitations are just going out. We have about 120 people registered already, and there is a room for 250. So if you're going to register, be sure to get a seat. Do it soon. And we'd love to see you on May 31st.
Great. Thanks, Lou.